to understand what hedging is.
Anand, part of that call, of course, depends on whether or not you're expecting to see appreciation or depreciation on a particular currency. Now, what all do you keep in mind while thinking about that? For example, if you're looking at the euro, what factors must you keep in mind to take a call on whether it's going to be 125 to the dollar or less or more?
Sure. In fact, all of us so-called experts in the currency market, to be perfectly honest, are very good at explaining why a currency moves the way it does after the move has happened. We're not so good at anticipating what really happens. And frankly, like I said, the kind of moves that we've seen over the last 2 years, I don't think anybody had got it all right. You know, the move up and then the following the move down in euro and sterling and so on and so forth. This is a very, very volatile market. There are any number of factors which go into determining why a currency moves the way it does. Most of it is obvious after the event happens. So you have, economic fundamentals, you have things like, actual growth prospects, capital inflows, outflows, trade competitiveness, exports and imports. You have speculative flows, people, sentiments, all of that translate into eventually demand and supply like any other market. And that demand and supply determines where things move. So, short answer, a CFO's job today is probably the most thankless job today. Very, very difficult to predict which way markets will move. Any amount of uncertainty is still left in the market, which is why most CFOs and frankly most treasurers and banks try and take a balanced approach of having not all eggs in one basket, but spreading things around a bit. Diversification, we call it. So maybe, if you're an exporter, have 35% in euros, 20% in dollars, balance in rupees, anything. I mean, depending on what gives you the most comfort. Now, things like futures and the OTC derivative markets are instruments which help you achieve that mix. I talked about the fact that most of our savings as individuals is in rupees, if we have savings. Diversification is probably something we all ought to think about. Instead of having everything in rupees, maybe we should achieve a certain portion in dollars or euros or yen or whatever catches your fancy to a certain percentage. Now, futures could help you do that. Now, the caveat emptor one must repeat again and again is be prepared for losses. Hedging does not mean lack of losses, right? And unfortunately, in traded instruments like futures, where you have margin calls and you have a mark-to-market happening on a daily basis, losses and profits are real things will come every day. So you have to be prepared for that kind of volatility, as anybody else does. So to answer your question, in today's market, getting it right is very, very difficult. That's obviously the best thing to do. If you get it right, fantastic. Most difficult thing to do. Most CFOs try and have a bias. So you might have a bias that rupee is going to appreciate. But at the same time, build in some amount of insurance. So in case your view goes wrong, current account deficit blows up like it seems to be doing right now, even if a dollar rupee goes to 50, it ought not to kill you. So you buy some protection options, so on and so forth, so that you have protection and insurance there. And spread your risks around a bit. Don't put all your eggs in one basket. So that's the broad approach. Then depending upon what volatility and P&L swings you're happy to live with, you could work out the mix.
Venkat, just one quick detail from you. I know you said that anyone can, participate in currency futures even sitting at home. But should you think about a minimum quota or minimum amount of cash you want to invest into this market when you want to get into currency futures?
See, it's like this. As I said, the minimum contract, the one contract is $1,000. So $1,000 at today's value, let us take at 47 rupees to $8, works out around 47,000 rupees. And if you take 5% margin, so 5% of 50,000 rupees, if you put in as a margin money, then effectively you will be in a position to trade. So at the maximum margin, what the market has seen is 4.18%. So effectively, if you put 4.18 rupees, then you can trade around 24 times of the margin money what you have put in to trade. And as Anand rightly mentioned, I would call it there is an efficient risk management system and there is mark to market every day so that your losses, they don't go very high because every day you are called to pay what is the loss you have made or the profit you have made. So you have to pay that money to the exchange on the next day. If you have made profit, you will receive that money from the exchange. If you have made loss, you have to remit the loss to the exchange. So effectively, there is an inbuilt risk management or the management of funds when you actually trade in that. So as little as 5,000 rupees, one can come and operate in the exchange traded currency futures platform.
Okay, time for a quick break. When we come back, I'm going to get our 3 guests to give you their one key message while looking at trading in this market. That's currency futures.